Hi, this is jeng, and today we're going to be talking about how do I determine my interest rate on my multifamily loan. And so we're going to talk about multifamily loan, the different types that are available. Number two, factors that impact your interest rate. Number three, we're going to give you some case studies of real deals. And then number four, sort of next steps on how to move forward with any of these loan types. So let's jump in. So there's really four main loan types that people are going to use, multifamily investors are going to use when they're financing their deal. And so on the bottom part of the slide, I give sort of a range of interest rates. So bank loan, you're going to be 4 to 5%. Freddie Mac SBL, you're going to be anywhere from 3 to 5%. Fannie Mae, anywhere from 2 to 4%. And then non-recourse bridge, anywhere from 5 to 12%. So let's just jump in. So we're going to look at the factors that determine where you fall within that range. So let's start with recourse bank loans or recourse bridge loans. So these are going to come from local banks. So these are going to be priced over federal funds rate. And so federal funds rate, if you look at this chart, sort of topped out at about 2.5% back in 2019, and then it dropped. They dropped it all the way down to about 1.5% at the beginning of 2020. And then once COVID hit, it dropped all the way down to essentially zero. So interest rate is going to be driven by two things. One is the federal funds rate, but then also a spread on top of that. So that spread on recourse bridge loans are going to be based off of borrower experience and their balance sheet. So about 50% is borrower experience and balance sheet. And then the other 50% is really going to be what leverage you're at and the debt service of the property. And so when we were doing deals in 2018, really the pricing, when federal funds rate was about 1.5%, the pricing on recourse bank loans was about 5 to 5.5%. And then in 2019, as the Fed started raising rates, federal funds rate up to almost 2.5%, we saw recourse bank loans at 5.5 to 6%. And we actually closed them at that range. And then we're pricing deals right now. So federal funds rate has come down from 2.5% all the way down to essentially zero. We're seeing recourse bank loans at about 4 to 4.5% right now. All right, so Freddie Mac small balance loans is the second type of multifamily loan that you can get. These range from loan amounts of 1 million all the way up to 7.5 million. These are non-recourse loans, and they are priced on a spread over the corresponding treasury. So if you get a, let's say 5-year loan, then it's going to be based off a 5-year treasury. 10-year treasury is the most consistent. That's what most people price off of. So I pulled up a chart of the 10-year treasury, and you can see that in the last recession, 10-year treasury was about 4%, and it dropped all the way down to about 2% in 2008, and then has steadily gone up and down. And then you see another big drop off sort of once COVID hit. It was at the beginning of 2020, it was probably close to 1.7, 1.8%. And now it's down about 100 basis points to about 0.7. And so that's one factor, right? The treasury that it's based on, but then it's also the spread. So what is that spread based off of? So starting at the top, for Freddie Mac small balance loans, really starts with the location of the asset. And so what they do is they grade every market sort of top, standard, small, or very small. And when they do that, so some your examples, your top MSAs are going to be your New York, LA, Chicago. Dallas is now on that list, but some of the top ones there. And then the small ones are going to be more of your standard markets, are going to be more sort of like your surrounding metros around Dallas, surrounding metros around Chicago. So maybe not like the center of the city. And then your small and very small, those are going to be based more on population. And so on the next slide, we'll have a breakout of the different markets. And then the next thing, after you tell me the location of the property, then so that's based on address and the county that it's in. And then we're going to look at your leverage, right? So it's going to start at 80%, then go 70%, and down to 55%. And then correspondingly, debt service. And so for each one of those hurdles, you sort of start at 80%, 125 debt service. Each one of those hurdles, each time you go down, you subtract about 4 basis points for each hurdle. The third thing that the interest rate is based off is prepayment penalty. So prepayment penalty, the standard is step down, right? So on a 10-year, it might be 5.5, 4.4, 3.3, 2.2, 1.1. And then if you go to yield maintenance, you'll get anywhere from 10 to 15 basis points off of that interest rate. The fourth thing is interest only. So if you decide, hey, I want a year of interest only, it's going to cost you about 4 basis points in the interest rate. And so for each year you add on, so if you do, let's say a 10-year, you might be able to get 3 years interest only, then you're going to add 12 basis points. And the last thing is affordability. So, Fannie and Freddie, their goal, their mission is really to do affordable business. And so if a deal is considered affordable, then it is uncapped. And what that means is Fannie and Freddie have a limit on how much business, how much loan volume they can do. And if it is, if the property qualifies on the affordability side, it is not counted towards that cap. And so in 2019, Fannie and Freddie were running very close to that cap. So if a deal did not qualify, was not affordable, then they priced it very wide or just didn't do it. So let's go through a couple of examples on the Freddie Mac small balance side. Let's say $2 million loan, standard market, in DFW, 80% leverage, 125 cover, and it was step down prepay with 3 years interest only. This was about a 3.72 rate recently. The same deal, same market, 80% leverage, 125 debt service, but let's say it was yield maintenance, right? So you subtract out 15 basis points or so, and then you take 0 years of IO. That's going to take off another about 12 basis points. So you're about 345. So when you're in there and you're pricing deals, these are sort of like the menu of options that you have looking at deals. And so you can decide, all right, do I want to pay a slightly lower interest rate but have no IO and a bigger prepayment when I go to sell the deal? So you have to make that decision as the investor. All right, this is a map. I thought this was actually a pretty neat map that one of the agency lenders had. And it shows sort of in red, the top markets you can see on the coast, sort of New York all the way down to Florida and in DC and Chicago. And then you see that one small dot for Dallas County MSA where I'm at. And then on the coast, the California all the way up to Seattle. Those are your top markets, right? And then your standard markets are sort of the ones just outside of those top markets a lot of times. And then the small markets anywhere from 30,000 to 100,000 in population. And then the very small markets, those are going to be your markets with 30,000 people or less. And so that just gives you an idea sort of how Freddie SBL maps these different locations across the US. And so here, this is like what we get on a either daily or weekly basis is that Freddie Mac will send out a range of interest rates, right? So if it's in a top market and you decide to use a 5-year or 7 or 10-year, then that's going to determine your interest rate. And so you can see down here on the bottom, it's saying this is going to assume a yield maintenance prepay, 60% loan to value, 135 cover, and no interest only. So that is sort of at this far left-hand side, right? So it's the top market and it has these things. But then as soon as you start adding on, all right, I want step down prepayment, and I also want 3 years of interest only, you're going to move up closer to this top end of the range. And so that's how Freddie is going to price their deals. And let's move over to Fannie Mae now. So Fannie Mae, similar to Freddie Mac small balance, it's going to be priced on a spread over the corresponding treasury, right? So we saw the 10-year treasury chart on the previous slide, but a little different here. Fannie Mae, the way they start out is they say, all right, what is your loan amount? Is it $6 million and higher, or is it $1 to $6 million? And the $1 to $6 million, those are the smaller loans. Those are priced about 70 basis points higher than your $6 million and up. So that is a very important threshold. If you're out there doing loans or trying to buy a property, you want to be over that $6 million to get the best interest rate on your loan. Second thing is the second thing is leverage, right? So leverage, they have 3 tiers. So it starts at 80%, 125. Then it goes to the third tier, which is 65%, 135. And the fourth tier, which is 55% LTV and 155. So it has to hit both of those metrics. Typically, it is debt service constrained at those different points. And so each time you go down in leverage, so you go from 80% to 65%, you get about 15 basis points off your interest rate. And then when you go from 65% down to 55%, you get another 15 basis points off your interest rate. So we start with the loan amount, then you go into leverage, and then you talk about prepayment penalty. So in Fannie Mae, the standard is yield maintenance. So on loans over 6 million, they almost always just quote yield maintenance. But then if you go into the smaller loans, so the 1 to 6 million, you can request step down prepayment, which is what they have on Freddie SBL. But your interest rate is going to be about 50 to 60 basis points higher in interest rate. The fourth thing here is green. So green just came back this summer. And so you need 30% total savings on water and electric. And then that's going to get you about 30 to 35 basis points of a lower interest rate. And then the same thing as Freddie, Fannie is really big on affordability. So if a property is considered affordable, then Fannie Mae will give you that pricing discount because it's uncapped business. And the last thing here, and this was bigger, probably 2018, 2019, is pricing waivers. And so Fannie Mae used to grant a lot of these, and it was more based on the borrower's experience, right? So if you have done 15, 20 deals and you've, a very experienced borrower, you're buying a very high quality property, then Fannie Mae might grant additional pricing waivers. So let's go through a couple examples on the Fannie side. Let's say a $12 million loan, 80% leverage, 125 debt service with yield maintenance, green, and it's affordable. Then it's about a 285 interest rate today. On the same deal, but let's say you don't qualify for green, then you might lose 35 to 40 basis points. So your interest rate might be 320, right? So that's a big change. But if your property just can't qualify, or it's just too expensive to do the green program, then you're going to end up with a rate probably in that low 3 range right now. Second example, we do a $4 million loan, 65% leverage, 135 cover, yield maintenance, and it's affordable, is about 340 today. But if you change one thing, you change over to the step down prepayment, because let's say you're going to exit in the first 2 to 3 years and you don't want to be stuck with the yield maintenance penalty. Well, you're going to pay a little bit higher interest rate. So your interest rate's about 50 to 60 basis points higher with that step down prepayment. So you'll be about a 4% interest rate. All right, so this is what we get sort of on a daily, weekly basis from Fannie Mae lenders. It says, all right, here's the corresponding Treasury rates. Right now they have floors on the Treasury rates. So even though 10-year Treasury might be 60 or 70 basis points, right now they're using a floor of 90 basis points. And then they're going to add on a spread of anywhere from, let's say, on a 10-year loan right now, if you're 80%, they're adding about a 210 spread on top of that. And then, so you're getting to about 3%. But then as you go from, let's say tier 2, which is 80%, if you go to 65%, you drop down about 15 basis points. And then you go down about another 20 basis points if you drop down to 55%. So that's just an example of, depending on what tier you end up and then what loan amount or what loan maturity, then that's going to determine where your spread is on that deal. All right, the fourth type of loan is called non-recourse bridge. And these loans are typically given out by non-bank lenders. So these are like debt funds. Sometimes they're just, so they raise money, or they might do a securitization and are out there offering these bridge loans. And the first thing that they do is price it a spread over LIBOR. So LIBOR is a floating rate is a floating rate. And LIBOR typically was probably at least 1% historically. And then in the last year, it's gone all the way. It's pretty much followed the Fed funds rate and is almost down to 0 right now. And so interest rate is driven by a couple things. First off, loan amount. So when I was at G Capital, we didn't really do any loans under 5 million. So 5 million is really the threshold. So you want to do bridge loans above 5 million, because once you get down into that 1 to 5 million, these loans are about 300 to 500 basis points higher in interest rate. Second thing, these are transitional loans, right? So they're shorter term, anywhere from 2 to 5 years. And so borrower experience and the rehab plan is very important. Like, have they done this before? Do they own anything in this market? How are they going to exit this deal, right? Because they want to see your ability to either sell the deal or refi this deal into Fannie Mae, Freddie Mac once you are done with your plan. And the third thing really is the leverage and debt service coverage, right? So is this a completely vacant building? Is this, it has some cash flow, but you're upgrading the unit significantly. So what's the story? They really want to understand sort of what the in-place cash flow is today, if any. All right, so let's look at example one. So $12 million loan, 80% leverage, experienced borrower. So because of the size of the loan, this is going to be LIBOR plus like 400 to 500 basis points. So your probably all-in rate right now is about 5%. Example two is a $4 million loan, 75% leverage, experienced borrower, similar rehab, but because of the size, there's just not as much competition, right? So in example one, that deal, there might be 10 banks bidding against each other, right? And so that bids down the price. But then on the smaller $4 million loan, there might only be 1 or 2 banks who are bidding on that deal. So they're at 8 to 9% all-in rate. And so really when you're under that $5 million loan amount, you as a borrower have to decide, all right, do I want just a recourse bank loan and maybe get that at 4 to 5%? Or do I want non-recourse and, stomach a 8 to 9% all-in interest rate? So my background, I was born and raised in Houston, went to school in Austin, and was an underwriter actually for GE Capital, doing bridge loans and CMBS loans. In the last 5 years, have been a mortgage broker at Old Capital, focused on multifamily lending and loan originations. And that is where I've done all these types of loans, whether it's Fannie, Freddie, recourse bank, or non-recourse bridge. And then also invested in close to 21 properties here in DFW, Austin, and San Antonio. So if you like this video, definitely subscribe to the channel, like the video. If you need help with a term sheet, send me T12, rent roll, offering memorandum, or if you just want to review a deal, send over the investment package. Let me take a look at it. I'll give you some thoughts on it, and set up some time to talk with me. Complete your personal financial statement, set up some time, whether you're buying, selling, or refinancing your next multifamily deal. All right. Thanks, guys.